Hi, Tempaholic, Gold Star Mortgage, back with step number 5 to my 8-step consumer guide to home mortgages. Step number 5, loan products. So now we're approved, you got approved, you're out looking for a home. What's the best loan product for you? Well, this comes back to when I talked about interviewing multiple loan officers. You want to have this discussion with your loan officer. What's the best program for me based off of my income and based off of my future goals? Now, um, back in, before the financial crisis hit 20 years ago, you had multiple products. You had ARMs that were adjustable rate mortgages, where their interest rate was fixed for 2, 3, 5 years, and then after that it adjusted. You had balloon payments, which was a mortgage that was amortized over 30 years, but the balance was due in 15 years, which would force the borrower into a refinance. You had interest only loans where you were only required to pay the interest and you never paid down your principal. So a lot of those have gone by the wayside. There are variances of them, but it's something that you would never consider when purchasing a home. But with interest rates as low as they are, what you should consider, because it will save you money over the long term, and a loan officer can break this down for you, is can you afford a 15-year mortgage? If you can afford a 15-year mortgage, you should absolutely go into a 15-year mortgage, because when you compare the amount of interest that you're going to pay over 15 years compared to a 30-year mortgage, it will blow your mind. And if it's on a $150,000 house, I guarantee you it's going to be over $75,000 to $80,000 and sometimes over six figures. So it's definitely something that should consider. And you shouldn't consider an ARM, but if not, go on to a 30-year fixed loan. So, but know the different products that are available to you. Those are the two main ones. And besides that, there's FHA and there's conventional loans. A loan officer will walk you through the differences in those, and that really ultimately depends on the amount of your down payment and the amount of mortgage insurance that's involved. Both products, if they're above an 80% loan to value, do carry mortgage insurance, and that amount does factor into your debt to income ratio. So when evaluating what's the best product for you, you have to look at the overall payment, not just the interest rate and the payment with your mortgage. So anyway, step number 6 is know your loan products and know what's available to you and discuss them with a professional. I hope you enjoyed the content and you find it useful. If you like the channel, please subscribe, leave your comments below, and talk to you soon. Thank you.